This is a fit to the quantile median regression in the upper chart. And then what I've done is I've modeled the bubbles in terms of their peak and their duration. And I set a threshold. I said, you're not in a bubble unless you're at least 0.2 in log 10, which is about 1.58 times the trend line. So these green triangles only measure when you're above 0.2 in log price over trend, and then they only measure how much more than that you are. And you can see that the power nose has come down with time. If you take the trend out, you get the lower chart, and so it becomes a little more clear. So these are just the residuals. These are the log 10 of the price residuals after taking out that quantile regression trend. And the triangles show the energy and duration above threshold. And you see 4 large ones, you see a bunch of little ones, both up and down. The smaller bubbles, none of them are of much significance. And there have been none since mid-2022. And the 4 major ones are separated by 2.5 years, 4 years, and 3.3 years. And I say 3.3 plus because the 2021 was a double bubble. And so the 3.3 takes you to the left hump, and then about 4 years to the right hump. But actually the left hump was bigger in terms of its deviation from the power law trend. It has a bigger residual. So in some sense, it was the truer portion of the bubble. So already you're seeing some evidence, though, of not a 4-year cycle because of that kind of weaker double bubble behavior.
So it never was a 4-year cycle. It was always like some kind of almost 4-year cycle.
3 to 4, 2.5 to 4. This one's interesting. And this is kind of the backdrop for the analysis of the log periodic power law of the bubbles. But Didier Sornat is a geophysicist who has developed this log periodic power law and used it to model earthquakes and other geophysical phenomena, but also financial series. And the name is a little confusing because it says power law, and it's got a power law in it, but it's not the same as our long-term power law trend. What it had, and the log periodic says basically that the waves are getting closer and closer together. So typically you would use it to analyze just some smaller portion of a year or two of Bitcoin, if it's in a bubble, to try and understand how the bubble's developing, because the waves get closer and closer together. And if you follow the red dash line, which is the fit, you can see that the peaks are getting closer and closer together. And this is bubble behavior that you frequently see in stocks as well as in Bitcoin. And he's written, he's published research papers on Bitcoin as well with this model. So the idea is that you get this parameter, which is this little omega, 8.55, and that's an angular frequency parameter. And it tells you in logarithmic time how these things are getting closer and closer together. And the other thing you do is you calculate a time when, they keep getting closer and closer together. They also, price gets steeper, and then you get a crash because, they get on top of each other and the whole thing fails. It's moving to a critical state, a critical failure state. This is the difference between exponentials. They don't last forever. They're seen in decay, in rise and in decay. So this tells you tries to tell you when you get the transition. I ran this model in July, and I used data from the beginning of 2024 through the middle of 2025. So it's a 1.5 years of data. And it predicted the peak at 123,000 and middle September. And the actual peak was 125,000, 126,000 in early October. So it's reasonably accurate. And I presented this publicly back in July. Now, so that's that idea. Now, to get into these log periodic bubble spacings, it turns out that Giovanni had taken a look at this in April of 2019, almost 7 years ago now. And he tried to fit the whole long-term behavior of Bitcoin with the model I just showed you, which is really more appropriate for shorter periods of time. But there is a version of it that uses less parameters. And I think his fit used probably less parameters. But what he did was he was able to roughly fit the cycles for the 2011, 2013, 2017 bubble. And because it was log periodic, he predicted that there would not be another bubble until age 18. So the first 2011 bubble is age 2.5. The 2013 bubble is age almost 5. The 2017 bubble is 9. You can see they're stretching out in time, roughly doubling. And so the next one was going to be at 18 years. This is a log chart. You can see the overall power law trend as well with the red line. And you can see the values that he predicted for X and Y, which are the log of the day count from the Genesis block. So I just calculated that, and it turns out to be 17.96 years, 18.0 years. So I've annotated his original chart. It's actually quite incredible because I've now taken another 6.5 years of data, almost 7 years of data to do the analysis, and I get a similar result, slightly over 18, more like 18.5 years. So he had already kind of found that it was not a 4-year cycle, it's more equally spaced in log age, and that the log periodicity is something close to 2, which means that the interval is roughly doubling. Okay, so here's the form that it takes, the equation for it. It's got 5 parameters. This is the longer term version of the bubble model. The shorter term I showed you is 7 parameters, so it's tricky to use, but this one a little easier. And what we're most interested is the terms at the end that have this omega and phi. The thing that looks like a W is the omega. And that's the oscillation frequency in angular frequency. And you can convert that to a wavelength, which is a distance. And in this case, it's a wavelength in time, not in space, in time. So for just the oscillation portion, we're fitting that. And this is the relationship between the wavelength parameter lambda and the angular frequency parameter omega. It's log lambda equals 2 pi over omega. Normally you'll see lambda equals 2 pi over omega without the log, but this is log periodic. So that's why it looks like that. Okay, a bit detailed, but what we're trying to do is determine what the best fit lambda is. And he had predicted, he had something that looked like roughly 2. Okay, so now I did a full Fourier transform analysis of all the data, and I found lambda equal 2.07. And the first time I did it against gold, Bitcoin and gold. So that's what this chart is showing you. This is showing the Bitcoin price residuals measured in gold ounces as a function of time. This is the linear age. And I looked at the fundamental of lambda 2.07, but I also looked at the harmonics. The first harmonic in frequency, which is the intermediate wavelength, and that's the blue lines. The fundamental are the red vertical lines. And then there's a subharmonic, which is a green line. So that's a slower one, the subharmonic. So people that, play music, you know what harmonics are. You have the C and then the next octave up, another C. That's a harmonic. And the result is that you fit the 2011 bubble, the red line, the 2013 bubble, the red line, and the 2017 bubble, the red line, but the 2021 bubble is not a fundamental. It's a first harmonic, and that's the blue vertical line that's at a little over 12.5 age, the double bubble, that's the 2021. You have some smaller little ones where the first harmonic kind of lines up, but they're not very meaningful. And then the subharmonic, there's a kind of small bubble around 2019 that sort of lines up with that. But the important result here is that the next red line is at age 18.4. And that's 2027 May. That's age 18.4 years. And if you redo this, Bitcoin versus dollar, you get the same result. You get a graph that looks very similar, red vertical lines, and you get an answer of 18.5. So right smack in the middle of 2027. The R squared is very high, 0.94 with Bitcoin versus gold. And the R squared of these fit. And this is a nice clean result because not only do you see it in Fourier transform, you see it visually really back with the work that Giovanni did, but also in the graph I just showed you. The value doesn't drift much. It does drift some. It tends to get a little longer with time. And my thesis here is that what you're seeing is discrete scale invariance. The long-term power law trend we call continuous scale invariance. It's always in progress. The bubbles of discrete activity happening at certain times, logarithmically spaced. So that's discrete scale invariance. And the argument I'm making is that that's due to capital flow that's coming in new hierarchy tiers. In other words, you started out with cypherpunks as investors, and then retail, and the first exchanges and miners. And then eventually you've gotten to treasury companies and ETFs and sovereign wealth funds and governments with their strategic reserves, right? So you have more and more capital tiers coming in, and those are larger and larger. So there's a hierarchy of capital inflow, and that helps to drive these discrete events. And this has a lot of similarities to things that we see in nature with earthquakes, with volcanoes, with financial bubbles, with phase transitions in physics. And the typical values for this lambda are about 2 in all these other cases. So the 2.07 just fits right in a general sort of physical range there. And some interesting kind of numerology here. You can just take lambda and lambda squared and lambda cubed and lambda the 4th and 5th power and add it to 2009. And that's when you see peaks. 2011, 2013, 2017, and 2027 and 2047 are the predicted fundamental ones.
Interesting. How high has it to go that it qualifies as a bubble in 2027?
I'll show you that. I think I'll show you that. But roughly, if you just look at the fundamental mode, it's about $350,000.
More than a 3x from here. Not bad.
Right. Yeah, 300 to 350, but you could get spiky behavior if you get, the bubbles don't explain, this doesn't explain everything. This is intrinsic structure within Bitcoin in the way that it adapts to capital inflows from higher and higher tiers, larger and larger amounts of liquidity that gets directed into Bitcoin. It does not account for kind of external stochastic stuff where you have herding, derivatives, options being used, leverage increasing, that kind of external stochastic behavior, which can kind of jump on top. It might not happen or it might happen, but can jump on top and drive more spiky behavior. And we typically see this kind of spiky behavior in these peaks. So once you activate, people kind of come in, right? They can't resist. That's the nature of bubbles in human psychology. So if we compare the Fourier model to the log periodic model, the Fourier model ignored 2011, but the log periodic model addresses it. And the log periodic model says 2021 was a first harmonic. The Fourier model said we should have had a bubble in 2025, but it failed. But the log periodic model explains that we didn't have one. And for 2027, you would not expect a bubble with the Fourier model, but we do expect one with the log periodic model. So we'll find out if I'm right, in 2027. But the Fourier model is right 3 times, wrong 2 times, and we've been right 5 times and wrong 0 times so far. And the RMS error of how much, these red lines and blue line, how much they varied from there. For the Fourier model, you're off by over a year as the average error, but for us, we're less than half a year. So the scoring on the timing and the root mean square error is superior. I don't have the curve here. Sorry about that, but if you just take the fundamental mode, you would expect to be at just under 200,000 at mid 2027, but the fundamental would take you up to about 350,000. And I have tweeted that one out, so it is out there in my X feed. How are we doing for time?
We do have another 20 minutes, 30 minutes.
Okay, so I'll go into the cities and companies a little bit. I recommend people take a look at this book, Scale by Jeffrey West. He's a physicist, started out, I think, in particle physics and started exploring the behavior of networks, the physics of networks, and the physics of scaling in biological systems, but in cities and companies as well, which are anthropological systems, right? He was president of the Santa Fe Institute. I think he's an emeritus now. Very interesting book. But for people that don't have time to read the book, go look at this YouTube. Search for Why Cities Keep On Growing and Corporations Always Die. And I think it's a TED Talk, but it's maybe it's not a TED Talk. It's an hour-long YouTube presentation that Jeffrey West gave. Okay, and this is the research results that he published in 2015 with some collaborators, looking at the lifetime of companies. 25,000 North American companies, 60 years of data. These are log linear charts and they're straight lines, so that means exponential. And what he's plotting is the fraction of firms that survive 10 years, 20 years, 30 years, 40 years, 50 years. And you can see it falls very steeply. So if we look at the right diagram, it runs from 3 down to 0. That's a factor of 1,000 because it's log base 10. And you can see how steep it's falling. And it's an exponential, it's compound annual decay. And the average lifespan that he found, exponential average life, is 10 and a half years. So companies are either acquired, bankrupt, spun out, go private. These are all publicly traded companies. Very low percentage survive 50 years. A fairly low percentage survive, more than 20 years. And I suggest this also applies to altcoins because they're more like companies or consortia. Bitcoin is unique. It's there's a name for it. I can't think of it right now, but it's a set of one. So that's companies. They don't behave like power laws. But cities do behave like power laws.
The first thing that every Bitcoiner does, and the most important activity that every Bitcoiner keeps on doing, is buying Bitcoin. And I personally use Relay to buy and sometimes also spend or sell my Bitcoin. And there are two main reasons why I do so. The first one is it's Bitcoin only. They do not do any shit coins. They do not do any cryptos, any stocks, or anything else. This is a tool, an app that is fully focused only and solely on Bitcoin. The second one is self-custody. They give you the keys to your Bitcoin the moment you buy them. You never give them the control over your Bitcoin, and you don't have to trust them because you can verify that you and only you have the keys to your Bitcoin. There's no third-party risk. There's no freezing of your assets. There's no rug pulling. There's nothing of that. Download Relay, the app, on your phone, or go to relay.app on your browser and use code Robin to save fees and get cheaper Bitcoin. I want to tell you about something very special to me. It's called micro seed. If you hold your Bitcoin in self-custody, and you should, you know how critical it is to secure your seed phrase. You should not have them on paper. You should not have them on anything else than titanium. With micro seed, you can engrave your 12 or 24 word seed phrase, the entire seed phrase, onto a 1-inch small washer. Yes, just one washer. All 24 words on that one washer. You can hide that thing everywhere. And even better, you don't need to buy a new kit every time you have to get a new wallet. You can make unlimited backups because MicroSeed is not selling the washer. MicroSeed is selling the device that stamps the washer. You get the full kit with the device, with the washers, with the hammer, with everything you need to get started today, and you can make with that unlimited amount of backups. Go now to microseed.io.